St. Louis Fed President James Bullard with some remarks on the economy and rates. Steve Liesman, what are the headlines?
Kelly, St. Louis Fed President Jim Bullard saying several factors may combine to make 2023 a disinflationary year. Among those things that will be factors are the Fed's front-loading and aggressive policy rate hikes. He says the policy rate is not yet sufficiently restrictive, but he said it's getting closer. And he actually showed one of his charts. Remember the one in November where he talked about this idea of a range of 5 to 7%? There's some suggestion in there that maybe 5% is closer to, or above 5% is where he thinks it ought to be. The policy rate, he says, will become sufficiently restrictive during 2023. Inflation remains too high, but he notes it has declined recently. Inflation expectations, he says, are back to relatively low levels, again, crediting the Fed's aggressive rate hikes for that. Second half GDP growth, he is making note of the stronger data we've had. He said it's going to be stronger than the first half, but he does see growth slowing down to being just below potential growth. The current labor market situation, however, he says, is unprecedented, and he's concerned about the possibility of increased financial stress, but notes that the market's transition to dealing with these higher rates, has been relatively orderly. So I'm not going to call this dovish, but I'm going to say it's not as especially hawkish as he might have been back in November when he talked about this range of 5 to 7% for a funds rate. He's still showing a range, but that top range has come down now, being below 7.
I'm watching the market to see if it starts coming back at all. Steve, stay right there as well, because we have to decide once and for all if the Fed needs to halt here.